Hey everyone, welcome back to Corporate Decoder, the place where we pull back the curtain on corporate filings to reveal the real story behind the numbers. And today we have Bank of America Corporation's latest report for the 3 months ending the 30th of September of 2025. It is jam-packed with juicy details about their financial health, their strategies, and some pretty interesting risks. We will be digging into their financial tables, understanding their strategies, and giving you the real scoop on what it all means for you as an investor, or just someone curious about how a giant like Bank of America operates before we dive in. You know the drill. If you love getting clear, actionable insights from these dense SEC filings, make sure you hit that subscribe button and ring the notification bell. And if you want to connect with other finance enthusiasts, join our Discord community, linked in the description below. Alright, let us get right into the numbers. Bank of America saw net income jump for the 3 months ending the 30th of September of 2025, hitting $8.5 billion compared to about $6.9 billion in the same period. Last year, that is a solid increase, and it translates to about $1.06 per diluted share, up from $0.81 in the previous year. For the first 9 months of the year, net income climbed to $23 billion from about $20.5 billion last year. Their earnings per diluted share also saw a nice bump from $2.40 to $2.85. This growth seems to be fueled by a rise in income from both interest and non-interest sources, while they also managed to lower their provision for credit losses, but non-interest expenses did go up. Let us break down where that income is coming from. Non-interest income itself saw a significant increase, reaching $12.9 billion for the quarter and $37.6 billion for the 9 months. Card income remained fairly stable, but service charges jumped up mainly from treasury services, investment, and brokerage services showed strong growth, particularly in asset management fees and brokerage fees. Due to more client activity and market valuations, investment banking fees also had a great quarter, climbing by over $600 million for the 3-month period, thanks to higher debt issuance and advisory fees market-making activities. However, saw a slight dip mainly due to lower trading revenue from certain products, and in a twist, other income saw a nice boost of $334 million for the quarter, mainly from lower partnership losses and valuation losses on derivatives. Now, about those expenses, non-interest expense for the quarter went up by about $858 million to $17.3 billion, and for the 9-month period it increased by $2.3 billion to $52.3 billion. This rise is attributed to ongoing investments in the business, including more spending on people, technology, and brand building. Also note that last year's 9-month period included a big $700 million accrual for a special assessment from the Federal Deposit Insurance Corporation, specifically for the increase in that corporation's share of the special assessment. It seems like they are investing heavily to grow, which is not necessarily bad, but we will keep an eye on how that impacts their bottom line. The provision for credit losses, which is essentially money set aside for potential loan defaults, went down for the quarter by about $247 million to $1.3 billion for the 9-month period. It stayed pretty much the same, around $4.4 billion. This decrease in the quarterly provision is a good sign, suggesting improving asset quality, especially in credit cards. Looking at the cash flow statement for the 9 months ending the 30th of September 2025, Bank of America generated quite a bit more cash from operating activities. Compared to last year, their operating activities brought in $35.6 billion compared to a use of cash of $34.7 billion last year. This is a huge swing, and it is great to see, especially with cash generated by selling off some debt securities and from a significant increase in trading account assets net of liabilities. This is a very positive sign for their cash generation capabilities. On the balance sheet side, total assets grew to $3.4 trillion by September 2025. That is up by $142 billion from the end of last year. This growth is mainly due to more loans and leases, like commercial loans and residential mortgages. They also saw an increase in securities borrowed and trading account asset. To support their clients, the liabilities also grew mainly because of higher deposits and more long-term debt issuances. Shareholders' equity also saw a healthy increase driven by net income and some preferred stock issuances. Let us look at some performance ratios. Their return on average common shareholders' equity improved to 11.53% for the quarter compared to 9.44% last year, and for the 9-month period it was 10.63%, up from 9.59%. Their return on average tangible common shareholders' equity also saw a nice boost, going from 12.76% to 15.43% for the quarter. This shows they are effectively using their equity to generate profit. Net interest income saw a significant jump of $1.3 billion for the quarter, reaching $15.2 billion. And for the 9-month period, it rose by $2.6 billion to $44.3 billion. This means they are earning more from the difference between the interest they receive on loans and investments and the interest they pay on deposits and borrowings, the net interest. Yield also improved. This increase is attributed to higher activity in global markets, fixed asset repricing, and loan and deposit growth, even with lower interest rates impacting things a bit. Card income remained pretty stable for the quarter at $1.6 billion, but climbed to $4.8 billion for the 9-month period. This segment is a consistent performer showing resilience. Service charges saw a good increase of $80 million for the quarter and $307 million for the 9 months, primarily due to more treasury service charges. This hints at stronger business banking relationships. Investment and brokerage services revenue had a strong showing, increasing by $517 million for the quarter and $1.6 billion for the 9 months. This is thanks to higher asset management fees from rising market valuations and more client money flowing in, and also higher brokerage fees from increased trading activity. Investment banking fees really popped this quarter, surging by $610 million, driven by more debt issuance advisory. And equity issuance fees for the 9-month period, it increased by $432 million. This segment is definitely firing on all cylinders. Market making activities saw a slight decrease of $75 million for the quarter, mainly because of lower trading revenue in fixed income currencies and commodities, or FIC products. This is likely due to market volatility, but they did see some offset from derivatives used in foreign currency risk management. The 9-month period saw a larger drop of $524 million, primarily due to lower trading revenue in credit products. The provision for credit losses decreased to $1.3 billion for the quarter. This is a positive sign indicating improved asset quality, especially in their credit card portfolio. Now let us look at expenses. Non-interest expense went up by $858 million for the quarter to $17.3 billion, and by $2.3 billion for the 9-month period to $52.3 billion. The company attributes this to continued investments in people, technology, and their brand. The prior year's 9-month period also had a significant one-time expense related to an FDIC special assessment. So the comparison here needs a little context. Their effective tax rate remained fairly consistent, though the income tax expense itself increased for the quarter, and for the 9 months this is largely due to higher income before taxes and also some discrete tax items. These figures are quite dependent on tax credits from investments in renewable energy and affordable housing, which is interesting to see them leveraging. Looking at the overall financial picture for the company, total revenue net of interest expense increased by $2.7 billion for the quarter to $28.1 billion. And for the 9-month period, it jumped by $5.4 billion to $81.9 billion. This shows solid revenue growth across the board. It is interesting to see that their average common shares outstanding decreased from 7.8 billion in the prior year to 7.4 billion. For the quarter, this reflects their ongoing share repurchase program, which is a way for them to return capital to shareholders. Now let us touch on risk management. Bank of America is a large accelerated filer, which means they are subject to stringent oversight. They manage their capital position to ensure it is more than adequate. We saw their common equity tier 1 capital ratio at 11.6%, which is above the regulatory minimum. This is crucial for a bank of this size. The report also details their expo sure to various market risks like interest rate risk, foreign exchange risk, and credit risk, and how they manage these through derivatives and other strategies. Like any financial giant, they are exposed to the ups and downs of the market, and geopolitical events are a big part of their risk assessment. They are managing credit risk very carefully, especially in their consumer portfolio. Their net charge-offs for credit card portfolios decreased, which is a good sign. Home equity loan portfolio also showed stable metrics, but they are watching interest only HELOCs closely, where early delinquencies tend to be higher. In the commercial portfolio, outstanding commercial loans and leases saw growth driven by global markets, and GWIM, their non-performing commercial loans, decreased significantly, mainly from the commercial real estate sector, but they are keeping a close eye on emerging trends like international trade policy persistent. Inflation and interest rates, the office property type within commercial real estate, is specifically mentioned as a concern with stagnant demand and uncertain future use. Their allowance for credit losses remains substantial at $14.4 billion. The breakdown shows the largest portion is allocated to credit card portfolios, then commercial and industrial loans. The net charge-off ratio for the company overall decreased, which is a positive indicator of credit quality. Looking at their credit ratings, Bank of America Corporation and its key subsidiaries have stable ratings from Moody's, Standard, AMP, Poor's, and Fitch. This is important for their ability to access capital markets reliably. On the liquidity front, their global liquidity sources are over $960 billion, meaning they have a substantial buffer for unexpected cash needs. Their liquidity coverage ratio is also healthy at 113% deposits are a major funding source, and they have a very stable base of long-term clients. This is a strong foundation for their operations. Bank of America uses variable interest entities or VIEs for securitizations and other financial activities. This is a common practice in the industry, but it is important to understand their maximum loss exposure to these entities is over $28 billion for unconsolidated tax credit VIEs and over $1.4 billion for other asset-backed VIEs. This is a significant number, but it represents a worst case scenario. The report details their fair value measurements, with most assets falling into level 2, which means they are valued based on observable market prices. They also have a portion in level 3, which involves more judgment and unobservable inputs. These level 3 assets are primarily loans and securities, where they are using techniques like discounted cash flow and considering factors like yield, prepayment speed, and default rates. This is where the most uncertainty can lie, but they are actively managing it. So what does the big picture Bank of America's latest filing shows? A company that is growing its revenue and net income. Despite a challenging economic backdrop, their investment banking and brokerage services are performing. Except Yayon, Aliwell, and their core banking operations are stable. They are also actively managing risks and maintaining strong capital and liquidity positions. The big concern to watch is the commercial real estate sector, especially office properties, and they are being prudent by increasing their allowance for credit losses. Their overall Bank of America looks like a resilient giant navigating a complex financial landscape. With continued focus on growth and risk management, its direction is still upward, but vigilance is key, especially in commercial real estate. And with the broader economic outlook, what is your take on these numbers and what they signal for Bank of America's future? Drop your thoughts in the comments below. If this deep dive was valuable for you, please hit that like button and subscribe to Corporate Decoder. For more insights like this, and remember to join our Discord community linked in the description for more great discussions. Thanks for watching, and we will see you next time.